Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, Money Farm. Now, Money Farm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 165 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How you doing, buddy?
I'm good. It's been an eventful week, Andy, for numerous reasons. I mean, one of the pieces we're going to do in the podcast, I have to mention it straight off the bat, but the stock market has collapsed this week, so it's interesting.
Do you know what? Ever since we've been doing this podcast, whenever I see anything that hits the main news headlines to do with finance and stuff, I think, that's going to feature pretty highly on this week's podcast. And it's kind of quite nice. I was saying to my wife, we're going to have a good one this week.
Yeah, so we could talk to the cows come home on what's happened this week. So just to give people a quick briefing, the markets have entered largely into a correction. I'll tell you what all that means. Kind of the what, how and why and what it means for you. But just to make sense of what's gone on, because one of the things is people panic when this stuff happens. But it was to be expected. But that was one of the things that blew up. But the other thing that blew up for me personally was my boiler. And I always use the analogy of the boiler. But last weekend, we were at home and my boiler started making some funny noises. And I thought, my God, I need to get someone in to look at that. And as soon as I thought that it just ceased to work. And I had no hot water or heating from Saturday through till it was the close of play on Tuesday. And just to give people context, if they listen to this in the future, it was one of the coldest 4 or 5 days we've had this winter. And it was horrendous. No hot water. It was like do you know what? It was like being back at my nan's house when I was a kid, when she had no heat. There's no central heating. You don't realise what you've got in life until it's gone, those creature comforts. So we had fan heaters and all sorts of craziness going on while the boiler was being repaired and fixed and parts and all that kind of stuff. So it was hard work. And of course with kids it's even worse. You worry about them. So that was my week. It's just things blowing up. My boiler seems to be in direct correlation with the stock market, although the boiler is back up and running and the stock market isn't. But so generally speaking, it's been a turbulent week. Although one piece of good feedback we had this week, which I'll just drop in before I ask you how your week was somebody wrote in about they'd read the 30-day money plan and they'd done a chapter on checking their tax code, and ultimately between her and her husband got about a £700 tax rebate, which makes my day. It's to hear that somebody got that. It gives me a warm glow for the times when my heating doesn't work. But anyway, Andy, how was your week?
My week's been good. Yeah, my daughter had her 8th birthday party last weekend. And that was really good fun. Just to give some context on that, her birthday falls on one of the most awkward days of the year. It's New Year's Eve, the day when no one else wants to... Well, I don't know. To be fair, I think the worst day of the year to have a birthday is probably the 1st of January, because that really is a day when no one wants to socialise.
Yeah, which is my sister-in-law's birthday, and she has said that. Yeah. She had her 40th this year, and she had that very issue that even if she wants to do anything, places aren't open, no one wants to go, they're hungover. But yeah, so you moved your daughter's birthday, did you? Like the Queen.
Yeah, exactly right. It falls on New Year's Eve, and people are generally doing their own things on New Year's Eve and are very busy. So yeah, we tend to move it 4 to 6 weeks in the future, and everyone's pretty much quiet around this time. So she went to a place called Clip and Climb, which I believe is a national thing. There's loads all around the country, and it's just amazing. Children get to, and it's really well managed, and children get clipped up and they get to climb over all sorts of obstacles, and it's really good fun. Yeah, teaching children to be independent and to face their fears, and really impressed with it. So look it up, people. It's a good party venue. It didn't cost too much, and we had lots and lots of fun. I'm still buzzing off it now.
And she thought it was okay too.
Oh, she hated it. She hated it. Every single minute of it. We're making her go again next week.
Yeah.
She loved it.
Did you know what I thought? I thought about changing my birthday. I'm a twin, so I share my birthday. I don't know what it's like to have a birthday which I don't share. And now, of course, my nephew, so my twin brother's son, was coincidentally born on the exact same day as us as well. So therefore, in my family, there is 3 of us who share the same birthday. And
do you know what's quite sad about that? Is at least it was always a thing that you and your brother, being twins, could share together, just the 2 of you. And now someone else has rocked up to the party and ruined that.
Yeah, so I had thought about moving my own birthday, but then it would be odd, wouldn't it, if you had one twin who had a different birthday to his brother. People will be raising all sorts of eyebrows at that. But anyway, on with the podcast. This week, Andy, I've got 3 things. The stock market is one of the pieces. I've got a piece that I was asked for by a journalist on group saving. So can you save money by banding together as a group of people?
Okay.
And the final piece is related to mortgages. And I just wanted to give people a bit of an FYI as to something they can expect in relation to mortgages and savings rates as well. So that's a small piece. So the stock market is the big piece. I mean, should we get that underway, Andy, and explain what's gone on? Because that's going to be the majority of this podcast.
Yeah, it's the elephant in the room, isn't it? It's what everyone's waiting for. Let's do it. So yeah, let's go for it. I'll strap in.
Strap yourself in, Andy. Right, to give you the idea of what has happened. Now, the stock market has completely fallen this week and has fallen by... It depends which stock market you look at, of course. If you're in Japan, it's been more than 10%. In America, it's been 10%. Not quite 10% in the UK, but probably will end up there. So a 10% fall from a recent high is what they deem as a correction. That's what the definition of a correction is in the stock market. So it tumbles 10% from that recent high. If it goes 20%, that's deemed to be entering a bear market. So that's pretty bad news. So what happened is that this week, it kind of caught people by surprise, the severity of the correction in the stock market. Now, we've been talking about this for some time on 80/20 Investor and the newsletters, and we've talked about it on the podcast about how stock markets are effectively being rigged by central banks, where they printed lots of money, which effectively has worked its way into asset markets. Like they bought bonds, and it's worked its way into equity markets, so it's pushing them all up and creating bubbles. So there's always this point where they unwind all of that. There's going to be some pain. Now, what happened, which is what makes it interesting when you look back at a car crash, it's like, you know those programs on telly when you see the airplane crash, Airplane Investigator, whatever it's called, and they look at the black box kind of thing. You start watching those programs, you get hooked.
I love those.
Yeah, and you start thinking, I don't know why I watch this. It should make me completely
they're so repetitive as well. They spend the whole time sort of leading up to the big thing.
Yeah, so what happened, what caused this crash at the moment, which is still at this point in time unfolding. We've had... As I have to timestamp this particular bit. It is Friday morning at the moment, so we haven't had the US stock market open on the Friday, but we have had a major sell-off of like up to 5% a day early in the week, and then yesterday in the US stock markets. Like I said, overall it's down more than 10%. And this correction has been faster than a lot of other corrections in history on average. And what caused it is there was the bond yields in the US Treasury market. Now, recently we did a podcast where we talked about looking at the outlook for investment markets in 2018, and one of the things we talked about was keeping an eye on bond yields in America, and particularly the US 10-year Treasury yield, and that is quite simply the rate at which America can borrow money at in global markets. So that rate was creeping up. And there was a rate of 2.5% that was the benchmark, where they thought, well, when we start getting that high, that's going to start creating the bond market to sell off. People will get spooked, and in turn that could cause an equity markets to sell off. Well, that started to creep up towards 3%, and I think at the moment as I do this, it's about 2.85, and that was the level where it seemed to, on last Friday, trigger the equity markets to get finally spooked. Because if that rate gets too high, the logic is, or the thought process is, that it feeds through into the US economy. So mortgage rates are based off of that rate. The amount that companies can borrow over the long term is based on the level at which that yield is placed at. Do you remember I said when we did the podcast that if people are going to lend to the US government at this particular rate, then they aren't going to lend to you at a lower rate, are they, Andy? It's going to be higher. So
That's right.
you can see that when that starts to increase, it starts to cause problems and starts people questioning the level of the US stock market. So what happened? That kind of tipped the boat a little bit, but then it completely capsized come Monday. And one of the reasons was the other measure that we recently have talked about called the VIX, which is the fear gauge, that people call the fear gauge anyway. And it's a measure of the volatility, the ups and downs on the US stock market. So when you look at a line, that wobbly line, that amount of volatility. Now, in recent years, markets have been abnormal. There's been no real volatility. It's been declining to historic lows. It's been so calm. It's like going down to the seaside and looking out to sea and there being no waves. And you've got used to that over a few years and wondering why is that? And think, it's just the norm. But actually, there's a tidal wave coming. That's kind of what's really happened. But the problem has been exaggerated because when that volatility level picks up, obviously stock markets tend to start to wobble. But there are all these very complicated financial instruments out there that allow people to short markets, which is meaning they can bet against them. And they've been betting for years that the level of volatility, so the level of fear in the market, was going to just keep falling and falling till we're all carefree. And that was largely because of central banks printing lots of money and really artificially manipulating markets and driving it down. So these instruments that people have been betting on have accumulated billions and billions of pounds of money, effectively saying, do you know what, it's going to stay this calm forever. But these products are what they call highly leveraged. So it doesn't mean that if you bet £1, you'd lose £1. If you bet £1, you could actually make, say, £2-3, but you'd actually lose £2-3. Well, what happened is when markets suddenly decided, do you know what, that rate in the US Treasury market, that it has got too high. It looks like there is going to be a whole wave of tightening around the US economy. Perhaps for the Federal Reserve are going to start raising rates. Global banks everywhere are going to start raising rates. They got spooked, but it caused that fear index, that volatility measure, to jump. But it jumped to a certain level so quickly that it caused a feedback loop, what they call negative feedback loop. So if you short the market, if you short anything, so you were to bet against anything happening in life, then as you start to lose money, you try to close your bet off, don't you? So you end up betting the other way. You try and close your bet off. But what they call is something called a short squeeze. And that means that when you're short and everybody suddenly tries to unravel that bet, it can cause that particular thing to the opposite to happen. So everyone's selling out of that bet. It actually caused the VIX to spike. And it drove it higher and higher and higher to levels we haven't seen in a long time. And it was the highest one-day trough to peak ever. And so we're talking about levels we're not seeing going back to like the financial crisis. That's how frightened everybody got. But it was also that fear index actually was exaggerated because of these short sellers. So what it meant is that translates into the stock market because suddenly everybody is looking at all these measures and are panicking and selling out. And then it also caused some quant strategies. And by that I mean computer-driven trading mechanisms to start unwinding bets, not just on that particular fear gauge, but on the stock market as well. So as certain levels were hit, they would then automatically sell. So you start getting one of these, again, these feedback loops, and it caused the market to plummet. And then when you have markets plummet in America, as soon as the Asian market opens, that tends to then follow from there. So when America sneezes, the rest of the world catches a cold. That usually applies to their economy, but it also tends to apply to the stock market. And if you look at the US stock market during the day now, this week has been so volatile, you can't even predict which way it's going to go. They have something called futures on stock markets, which is, again, a way of not quite betting, but it is betting really about where the market is going to open. So after hours, you can see where the market's going to go. And you can look at those and think, oh, well, it's positive, so the market's probably going to open higher when it eventually does. They're really giving no guidance anymore, because what's tending to happen is at the end of the day, in America in particular, is the market is experiencing some sudden massive swings, and the thought is that that's partly because some of these huge ETFs, these huge funds, are suddenly unwinding bets or closing out positions at the end of every day. And so what we're getting is some crazy volatility which is unusual for the last few years, but isn't in the wider context of investing. Now, a 10% correction in the market sounds scary. If you've got investments out there, a pension, if you looked at it this week, you will notice you'll be down sort of a fair, maybe 4, 5, 6% or something like that. But that's not unusual. 10% corrections occur even in equity rallies, so in sort of long-term uptrends, you do get them. The fact we've not had one for so long is what is unusual. That doesn't mean it's any less painful. I hate the term healthy correction, which you hear quoted on the TV. That just sounds to me that the person's just hoping that things won't get any worse. So you take that in the round, we're in a market that was expensive on historical terms. It was poor value for money, and it had run up really quickly. I mean, particularly in January. So where we are at the moment, we've given back a lot of the gains that we've made since perhaps the back end of last year, say November, December. So it's not a complete disaster in it by any stretch. That's all that's happened. It's going back to about that time. So if you imagine that quick run up we had, we've given up those gains. So if somebody had been investing in the market since before then, they won't necessarily be overall sitting on particularly big losses. What was interesting about it was the way the market sell-off happened. It was a case that all boats fell at once. So it didn't matter what asset you held. The only thing you could have done was been in cash. And that is always going to be the case in a really severe sell-off, because the panic just spreads across asset groups.
Can I just check, Damien? So just to understand it right, in the very rare situation whereby someone got really lucky, so let's say someone's been in the market for a fairly long time, they've taken advantage of all the gains of the calm waters over the last year and achieved slow but steady growth of their funds. And let's just say, just out of sheer luck or maybe a bit of a punt, they pulled all of their money out and they put it into cash 2 weeks ago, and now they're ready to go back in again. Are they the real winners here? Do they literally not lose in that situation? They pulled out at the high and then they're going to go back in after the correction. Is that how it could work? I know it's very rare. Why would someone do that? What would lead up to that situation? But if that happened, would that be the scenario, that they've not lost?
Yeah, that would be the scenario. And over time, you could see this was always going to happen, and there were lots of factors. If you imagine, there were so many things that were building up in the background that knew this was going to happen. It's been the most hated equity rally as I can remember, and so everyone's saying it's going to happen, but they just don't know when it was going to happen, and it's happening now. So in that scenario, those people would, if they then bought back in, they would be, compared to their peers, 10% better off if they went back straight into an equity tracker. So that's just market timing. It would be luck. But what I want to remind people when they look at this is, in its wider context, that, as I said, the losses so far have been okay. They've been severe. It's been painful, but it's what is natural in stock market and in investing, and there isn't really much you can do when the market does this. So one of the things you have to remember is, as a long-term investor, I'm not a day trader. Most people who listen to this podcast won't be day traders, so you shouldn't get too het up in the moves of in during the day or in very short periods of time. You've got to look at the fact that you're investing for 10 years plus, or your retirement. And when I was asked in the week what people should do by a journalist, I just pointed out the fact that you are realistically going to have many more and many probably worse periods of volatility and sell-offs than this one, because that's what markets do. So it isn't really all about what's going on now. There are going to be others, and people it's a healthy reminder to people who have had profits and enjoyed a lot of this rally. If they suddenly are becoming nervous about what's going on out there, and they're looking at their portfolios, looking how much they've made or lost on a day-to-day basis, it's a good reminder as to whether they are really, or they really have the stomach for being a long-term investor, whether they really are a long-term investor, and whether they should think about reducing risk. And that can be holding more cash positions or diversifying. But at the end of the day, you only have a very few levers to pull because you can't control the stock market. And one of the biggest ones is, of course, risk and your time span. Because if you increase your time span, what goes on during a short period like this has a lesser impact. So just to use extreme thinking, which I always like to do to try and illustrate a point. If you only invested for a week, then what's happened this week would be disastrous. But if you're investing for 20, 30 years, what happens this week is going to have minimal or less of an impact on where you're going to eventually end up, if that makes sense. So if you extend your time frames. So yeah, that is my take on what's gone on in the market. Those people who bet against the market, those volatility products, they've completely wiped out. They've blown up. These products are worth billions and they've just blown up overnight because the losses exceeded what was invested in those funds. So that's why the problem was so severe in the correction. You had a point where these things exploded. Now that seems to, if people listen to this thinking, I just remember things kind of blowing up and exploding in the financial crisis. That doesn't sound very good to me. Well, it doesn't to me either, but they seem to think that there isn't any systemic risk, so something that's going to unravel like it did in the financial crisis. We'll have to wait and see whether there is, or whether it's just isolated to these people who are betting heavily that the market would just remain calm forever. One of the other things to bear in mind is it'll be interesting to see what central banks do going forward, because obviously when the stock market starts doing things like this, they say they don't really think about it, but they do, because it will influence maybe their decision to raise interest rates, particularly because the way the market is behaving was initially triggered by the realisation and the accepting of the fact that QE and all those things are going to be unwound. So it's an interesting time. If that's the one thing, if you're investing now, you're learning so much so quickly in short spaces of time when this happens. But I would just say to people is perhaps turn the TV off. Don't listen to all the headlines. There's so many people out there will tell you whether it's going to go up, it's going to be the time to buy, is the time to buy the bounce, sell out. My view is that you've got to be prepared that the market could go even lower. And if you're not prepared for that, then you might have to question whether you should be investing and whether you are really a long-term investor. But there will be a point that you get to, which I talk about in this week's 80/20 Investing newsletter, where buyers will come into the market, and it's trying to work out how far away that point is, which is tricky, but that's an interesting aside. So there you go, Andy. That is the what, how, why, and how it impacts people, and hopefully helping people to get a bit of perspective of what's been going on this week. So we'll probably talk a bit about it again next week, but it's just fascinating, even if you're not really into investing, as to what causes these problems. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers, and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so you mentioned a piece about mortgages. What we got?
Right, this is just a bit of an FYI to people, because obviously we're in a world where mortgage rates have been very low and the best buy tables have been very attractive for some time, but then they start to creep up because people are thinking the Bank of England is going to start raising interest rates. And they did hint this week when they had a meeting that the interest rates are likely to go up sooner rather than later again. And now not to date this podcast, but we're talking probably in the next few months that we could have another interest rate rise. But what I want to talk about, I mean, that's obviously going to put upward pressure on mortgage rates. So lenders are going to start having their best rates will start to go up. So the best buy tables will start being less attractive, and you're going to have to pay higher rates if you take out a new mortgage. But there was another thing at play behind the scenes. I don't know if you remember, but when they cut interest rates a couple of years ago, when we had the Brexit vote, they cut interest rates by, this is the Bank of England I'm talking about, by 0.25%, which was just meant to try and stave off an economic slump. Now, some people might say they overreacted, but part of what went on behind the scenes of that, in order to make sure people passed that saving on and try to encourage more liquidity in the market to help the economy, they also created a scheme called the Term Funding Scheme, which really meant that banks and building societies could borrow money at a ridiculously low rate, almost free. So they could borrow money, and therefore they would presumably lend it out and be more encouraged to, because if you can borrow money for almost nothing, you would lend it to someone else for even a very small profit. That was the idea. So there was about £106 billion worth of that was taken by the banks and building societies, and that worked out to be about £3,500 per adult was taken. So it shows you the sums of money. Now that was meant to have worked into the economy. It was meant to have helped keep the rates on mortgages low, and it meant as well that banks and building societies didn't have to compete for savers' money, because they would be able to get funds. Because normally, if you think about a way a bank or building society might work, they might have to pay attractive interest rates to attract customers, which they can then use that money to lend to somebody else in the form of a mortgage or whatever. They didn't have to do that, so savings rates were low. But what's happening, this scheme is coming to an end at the end of February this year, and the banks are going to have to start paying that money back over a couple of years, but it does mean a slight unwinding. So we've got another unwinding process, like we had the unwinding of QE. This is an unwinding of a scheme that helped banks not to have to offer competitive savings rates. So it may be good news for savers that rates might start going up a bit, especially if the Bank of England starts raising interest rates at the same time. But the bad news for mortgage borrowers is that it will probably push up the rates on mortgages over time. So again, it's a kind of, if you were thinking about remortgaging at some point, then you are more likely to be, or you'll probably be better off thinking about doing it sooner rather than later, rather than keep putting it off. We have a tendency to put it off until rates go up. It looks like the trend is going to be now starting to creep higher. So that was a bit of an FYI.
Good, and we're going to finish off with group savings, the power of people and clubbing together to make savings. What have we got here?
Right, I was asked this again by a journalist about group savings. Can you save money by clubbing together? And I'm going to rattle through these because I'm conscious of the time on the podcast. But you can. It's not as prevalent as I thought it would be. I thought there'd be better ways or lots of ways to save money, but you can, particularly on travel. Now, if you travel by train and you're quite flexible, you can, if you're a group of adults, so 3 to 9 adults, you can get group save tickets that can save you a third of the train fare if you travel together, which is obviously a lot of money. Now, if you are not a group of 3, you're more of a group of 2, so you are a couple that will travel around together, you can get a 2 Together rail card that costs £30 a year, but that can knock a third off your train travel. And there's also a family and friends card, again costs £30, but it allows 4 adults and 4 children to be on the card. And the good thing about this one is they don't all have to be there to use it. So if, for example, you weren't all going out on the same day out, there could be, you're allowed to use the card as long as there is 1 adult and 1 child around, and that can save a third for adults on train fare and up to 60% for kids. And there are other, National Express, the coaches, if you have a group of 4, you can save 25% on their fare. So there are things like this that you probably don't realise. Just if you're going out in a group, it is possible to get a discount if you plan ahead. Now, when it comes to actually going somewhere and doing something, then the website groupline.com does group discounts on things like theatre events. So if you're going up to London, you can get discounted tickets to a show. And I went on there and had a look, and there's loads of things you can do, and there are some attractions in there as well. Not so many theme parks or anything like that, but there are things like I think London Dungeons, those sorts of things. So the attractions that are based in London. One of the others, Facebook is a good place to find these group savings. There was a group called Let's All Go Tickets, which is based largely in the southeast, but not exclusively, where they have a group you can ask to join, and it's about people clubbing together in groups to get a group saving. So they'll go to a particular place, maybe it's a farm or something like that, and they'll all get a group discount. Even though you don't personally know those people, you go and get a collective discount, which I thought was quite a nice idea. So
it's a lovely idea. I think it's a great idea, using the community aspect of Facebook to come together to have the shared goal of spending a nice day out with the children, but all saving money at the same time. And do you know what? The attractions wouldn't have a problem with that either, because the more the merrier. The reason they offer these group discounts is because they want more people through the gate. So everyone's a winner there.
Yeah, and I like those. If anybody knows of any more groups like that, then do tweet in, do tell us, because I'll talk about them. Because I find Facebook quite difficult to search and find to get those things. And I was made aware of that one because actually my wife made me aware of that particular one. But there must be others around the country, so do let me know. If you want to save money on food, obviously there's bulk buying, but things like Costco, you can do that if you have somebody who's a member of that. Yeah, you can take an extra person and you can bulk buy. I know people who do that. But there's also the digital world, as Sandy realised, that people want to share. So there's Apple have a home sharing element so you can share digital content and not have to have multiple subscriptions. But Amazon even do it. They have an Amazon household where you can share the benefits of Prime with other people you nominate. So that could be free delivery and some of their digital content. Of course, I don't condone this. There's people who do share logins for lots of things, including Sky TV and BT Sport and all these things that mean that you can have those services on multiple devices. It don't always specify where that device's location is. But the other one on taxis was, I didn't know this, but because I've not used it, but Uber, if you can, if you don't have any particular anti-Uber feelings, but you can, if you want to, you can take Uber Pool, which is an option. Rather than you pay for the whole Uber taxi yourself, it can pick up people who are going your way, and therefore you share the cost of the taxi. Uber Pool. So there you go. A bunch of ideas. If you have any more, send them in via Twitter, money to the masses with the number 2.
Good. Enjoyed that one this week. Learned a lot as always. Anything else to mention?
No, please give us reviews. We didn't read out any this week, but that was because it's been a crazy week. So we will go back to doing that. So give us some reviews and tell your friends about the podcast. We're getting lots of good feedback, and there seems to be a wall of people who are starting. They really are sharing. Say, I tell my friends, etc. about it. So please do that.
Great. And if you do go onto that Facebook site that Damien mentioned, maybe tell the guys there where you heard about it and share the love of the podcast there and other places as well. And so that's it. We're done until the same time next week. Bye-bye.
Goodbye. I'm only laughing here. We're saying goodbye because you don't realise Andy just did about 3 or 4 takes trying to say goodbye, and he sounded so cheesy. But anyway,
I sounded like an 80s DJ. It was awful. I was thanking people for tuning in and all sorts.
I was going to say leave it, but the fact was Andy swore in the in the middle of it. He's frustrated. Anyway,
anyway, we're off.
We're
music.
Off.
Can you hear the music? We've got to go.
I think we've got to go.
Bye.
Bye.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.